Hey everyone, Justin Conroy, Financial Dad here, and today I want to talk about capital gains taxes. For those of you who aren't aware, the IRS taxes your money differently depending on how you make it. And most people will only ever need to worry about taxes related to your normal income, but if you ever sell any assets or stocks for profit, you might be subject to capital gains taxes. This is really important to know because, of course, if you ever misreport your earnings on your income taxes and you make a mistake in your payments, you could be subject to some pretty hefty penalties. So in this video, I'm going to explain capital gains taxes, when they matter, how they work, and what you can expect to pay in taxes if you make a profit from the sale of any assets. Keep in mind though that this is meant to be an introduction, so I won't be getting into any of the special cases that can arise. Always seek out help from a qualified attorney or CPA if you have specific questions, and don't rely on random people from the internet. But hey, with that, do me a big favor and smash the like button for the YouTube algorithm, and let's get this started. First, let's answer the question, what is capital gain? Well, it's actually pretty simple. By definition, a capital gain is just the increase in value of an asset that you hold. So, for example, if you have stocks that gain in value, a piece of property that appreciates, or if you own part of a business that gains in value, all of these things count as capital gain. But you don't need to worry about paying taxes on any of that stuff until you sell your asset. As long as you're holding your asset, the IRS really doesn't care about its value when it comes to paying capital gains taxes. So when do capital gains taxes actually matter then? Well, capital gains taxes kick in when you actually sell an asset that has risen in value. That sale counts as a taxable event in the eyes of the IRS, and at that point, you're subject to capital gains tax, which is different from your normal income tax. To say it a little bit differently, your income tax is taxed one way, but the profits that you make from the sale of assets, your capital gains, have different rules completely on how you're taxed. So let's say that you buy an asset, it rises in value, and then you sell it. How much money should you expect to pay in capital gains taxes? Well, this depends on three factors. Number one, what were your net capital gains when you sold your asset? Number two, what is your taxable income? And number three, do you have long-term or short-term capital gains? Once you have the answer to those three questions, calculating your capital gains tax is pretty straightforward. So let's take a look at the first question. What were your net capital gains when you sold your asset? Well, this can get a bit complicated, but in its simplest form, your net capital gains are simply the sale value of the asset minus the purchase price of the asset. In other words, what did you sell it for minus what did you buy it for? For example, if you bought a home for $150,000 and later sold it for $200,000, your net capital gain would be $50,000. Now there are ways of lowering that number legally to reduce your tax burden, but that's beyond the scope of this video. I highly recommend that you talk to a tax attorney or a CPA for help in those areas. Next, we need to answer the question, what is your taxable income? This one should be pretty easy to answer because if you're worried about reporting capital gains taxes, you've probably already calculated this number. Basically, this is going to be your gross income from wages, salaries or tips, income from interest, dividends, IRA distributions, pensions and annuities, Social Security, capital gains, and any other income you might have. All that minus your adjustments, minus your deductions. So on the IRS Form 1040, it'll be line 11B. This is an important number, so keep it handy for later. Okay, one more question before we can figure out how much capital gains tax you'll owe. Do you have long-term capital gains or short-term capital gains? Generally speaking, this is an easy one. If you held the asset for under a year, it'll be classified as a short-term capital gain. Anything over a year will be classified as a long-term capital gain. If you're somewhere near the boundary line though, the IRS will tell you that the real cutoff is counted from the day after the day you acquired the asset up to and including the day you disposed of the asset. Alright, so we have our three variables in hand. You know how much capital gain you need to report, you know your taxable income, and you know if you have short-term or long-term capital gains. Great. So how much do you owe? Well, it's actually really simple from here. First things first, if you only have short-term capital gains, well, this is actually really simple. There's nothing special about your taxes because it just counts as normal income. Therefore, you'll be taxed using the normal graduated rates for income tax. Next, if you have long-term capital gains and if your taxable income is less than a certain amount, you don't owe any taxes on your capital gains. For 2020, this magical number is $78,750, but please check for yourself to be sure. I'll put a table up here on the screen for the other situations, so just be sure to pay attention if your taxable income is higher than the $78,000 threshold. You will owe some capital gains taxes. Most likely it's going to be 15%, but if you make crazy amounts of money, you might owe 20%. Cool. So now you know if you owe 0%, 15%, or 20% of the capital gains value. That's pretty much it in most cases, but there are a few exceptions to note. If your capital gains is from the sale of a qualified small business, collectibles such as coins or art, or unrecaptured sale of property, you might have a different tax rate. Most likely it's going to be 25 or 28% depending on some other factors. Well, there you go. I hope you learned something. Capital gains taxes were definitely a surprise for me the first time I had to deal with them, so hopefully now you at least have the basic knowledge and vocabulary to talk to a qualified professional if you have specific questions. If you made it this far in the video and found some sort of value in it, whether it be entertainment or education, be sure and smash that like button for the YouTube algorithm. Smashing that like button lets YouTube know that you enjoyed this content, and they use that data to help decide if they should push this video to more people, so it really does help this channel grow. Also, I post new videos about wealth building, money management, and personal finance every week, so be sure and subscribe down below for more content if you haven't already. Also, if you're new to personal finance and need a beginner's crash course, be sure and check out the video on the screen right now, because it will cover the basics that you need to know and will help you get you on your path towards wealth. Thanks for watching. We'll see you next time.